Hello everybody! In this video we will speak about a top question for the traders. What will indicate the economic recovery from the consequences of the coronavirus pandemic? Panic sellouts in the stock markets caused by the global coronavirus outbreak reduced the prices of the company stocks to the levels where they seem very attractive. Is it time to buy stocks? Let's try to analyze the situation. Fast market recovery would help investors to get their 30–40% of profitability. However, if the recovery process will take a long period of time, your portfolio may show losses for several years. So let's be patient. Our simple recommendations would help you to approach the stock purchases reasonably. Fear and greed move the financial markets. The unprecedented volatility shows how emotional the investors could be. The US stock market easily fell and skyrocketed by 10% and more during neighboring sessions. Such moves were observed only a few times during the whole history. It's not a surprise that the VIX volatility indicator exceeded even the highs of 2008–2009 at its peaks. It makes sense to take into account several significant features which distinguish the 2020 crisis. A pandemic of the COVID-19 scale was observed for the last time more than 100 years ago. There are no relevant historic data to assess its potential impact on the market. The nature of the infection hasn't been studied properly yet, and the fighting algorithm is still being developed. It may happen that after the current epidemic dies down, the world would face its new waves. According to the IMF forecasts, the world economy would experience the strongest fall after 2009. Some experts say that the GDP of the US and other developed countries may crash by 30–50%. The world has never experienced such crashes before. The global debt level has significantly increased during the past decade, which creates much default risks for both the least financially stable companies and the whole countries. The table shows the largest debtors in the world. So, the hurry in an investment portfolio formation could only bring harm. There is a probability that the stock value would stick at the March to April levels during the whole 2020. As of the end of March, we already know about the following measures of the central banks and FRS. The US FRS decreased the discount rate from 1.5% to 0. An unlimited quantitative easing QE program was declared. It means that the money printing press works at the full capacity and the system could receive, according to some estimates, up to $5 trillion through the purchase of bonds and other assets. ECB announced its QE for €750 billion till the end of 2020. The People's Bank of China reduced the reserve requirements to the banks, which freed up around 5,050 billion yuan. The Bank of England, the Bank of Japan and other central banks announced their own programs of stimulation. Injection of liquidity has already helped the S&P 500 index to slow down the fall, at least temporarily. We can observe the effect in the index futures chart. We want to remind you that FRS measures in 2008–2009 for fighting the crisis turned out to be efficient. Stock indices passed the bottom and started to show sustainable rates of growth several weeks after the launch of QE in the volume of $600 billion. Also, the US economy started to recover. Programs of asset buyouts were prolonged in 2010 and 2012. In total, they lasted from the end of 2008 until the middle of 2014, and the asset buyout on the FRS balance reached $4.5 trillion. The S&P 500 index increased by 130% during that time. The ECB, the Bank of England and the Bank of Japan undertook similar measures supporting the local markets until 2020. Despite the impressive results of stocks after QE programs in 2008 to 2014, investors need to remember that the asset buyout is not a guarantee of the market growth. It's just the basis of the foundation, but not its only component. So, how to understand that it's time to buy? The first block which we would assess is the macroeconomic statistics. The service and non-production industries, as a rule, take about 2/3 of the GDP volume of the developed countries. A rich economy rests on three pillars: employment level, consumption activity, and investments. It makes sense to monitor those markets where you plan to invest. As an example, let's take the US economy statistics. Very important statistics is published every Thursday on a quantity of initial jobless claims. The data were shocking on 26th of March in 2020, since the number of claims grew by 3 million. You should also pay special attention to the Purchasing Managers Index (PMI) at the end of every month. It's an important leading indicator which shows expectations of the business for the nearest future. The index is formed with the help of entrepreneurs' opinion surveys. The PMI below 50 shows a high probability of the industry recession, while above 50 – industry growth. The most important indicators for the US market are the PMI in the service industry and the composite index. As we can see from the data published on 24th of March, the PMI in the service industry crashed from 49 to 39 points. Until the initial jobless claims and the PMI indices start to show a sustainable improvement of the situation, the growth of the stock market would not be sustainable too. So, let's imagine a situation when the world economy starts to recover after the crisis, and it's time to move to the most responsible part of our work – portfolio formation. Life hack number 1. It's desirable to split the process into several stages. For example, you can form 25% of the portfolio after the first signs of economy stabilization, 25% when the economy starts to recover, and gradually by another 25% in the course of further recovery of the economy. It's also useful to keep always about 25% of your portfolio in cash in crisis situations. Life hack number 2. Buy index ETF instead of individual stocks. Due to this, it's useful for beginners to pay attention to ETF, which smooth down the volatility inherent in small stocks portfolios and in the majority of cases help to improve the financial result. Life hack number 3. Use filters. The stock screeners allow selecting securities by a variety of fundamental analysis indicators, including such important ones as the company's price-earnings (PE) ratio, earnings per share (EPS), debt-equity level, dividend yield, and many others. In the end, we want to repeat the main rule once again. The main task of an investor is to preserve the capital regardless of the crisis type. Something cheap may become cheaper and something expensive may become more expensive. Investors who remember the 2008 to 2009 crisis and further market recovery during several years learned this lesson well. Successful investments to you!